What if I told you there was a mortgage product that allows you to pay off your home in a fraction of the time? This isn't your average 30-year fixed loan. It's called the all-in-one loan, and it's changing the game for homeowners, allowing them to build wealth faster. Let's get into it. Hey guys, you're here with Las Vegas Real Estate with Ryen, and I help busy professionals and families relocate right here to the Las Vegas Valley without all the stress, confusion, the late night Googling, or the overwhelm. Full service approach takes care of you from day one to move-in day and beyond. Okay, so regardless to where you are in your journey, I would love to help you. Call me, text me, my info is in the description. But today, I'm excited to talk to my girl, Donnie Strickland from CMG Loans. Girl, how you doing today?
I am doing wonderful. It is such a pleasure to be here with you.
Thank you. So I love conversing with you because you are such a strategist, right? You think out of the box, which is what we need in this industry. Okay, you're always dropping gems. And when you came at me with this new program, I was thrilled. I was super excited. And also I figured that there's a lot of people who don't even know about it, right? So today we're going to talk about the all-in-one loan. Tell me, what is that about?
Okay, so the all-in-one loan is a really, really unique product.
Okay.
In fact, it's actually something that CMG developed and patented over 20 years ago. So it's not available anywhere else. So that's one of the biggest reasons that a lot of folks haven't heard about it.
Okay, that makes sense.
So it is pretty unique that way. It's an absolutely amazing program for those clients that are going, but I'm afraid to sell. I don't want to give up a once-in-a-lifetime rate.
Oh, yes.
Because, a lot of agents will turn around with rebuttals that sound like the whole, marry the house, date the rate.
Right.
Or, the price you pay now is forever, the rate's not.
That's right.
Or is the home really serving you? Is this the house that meets your family's needs? And so, but personally, my favorite rebuttal for that is you're sitting on tons of equity and a fantastic rate. That's freedom. That's not a prison.
That's right.
That's opportunity. And all you need is somebody that can help you strategize that to take advantage of it.
That's right. Oh, I love that. Thank you. Thank you. So what makes it different from like a 30-year fixed, for example?
Okay, so let's take a look at a 30-year fixed. I've actually got an example that I can put up on the screen here. In this, you can see we're working with a purchase price of about $650,000 with 20% down, gives us a loan amount of $520,000 on a 30-year fixed at an interest rate of about 7.35%, which was common when I first set this up.
Okay.
That monthly payment is going to look like about, that says $31.92. Sorry, $31.92. Sorry, on my screen it comes out microscopic. But the hard part in that is if you're actually looking at how the payment gets applied on that, the funds are applied first to interest and then to principal, which means in that very first payment, the interest is so high that less than $400 of that payment gets applied to the principal. So 30-year fixed rate mortgages are extremely front-end loaded on the interest. In fact, it's so bad that the interest to principal ratio does not even out until you're between payments 247 and 248 out of 360 payments. Ooh. So you're not even having half applied to principal until you get way more than halfway through the loan. Right. Halfway through the loan would be 180 payments. Right. We're talking 240.
Right. And then if you refinance, you're starting all over again.
Yep. Yeah, what's the first thing you're going to do when the 30-year fixed rate gets down to 6% again?
Refi.
You're going to pay $4,000 or $5,000 to refinance, and you're going to start that 30 years all over again. So that's why we created that all-in-one loan, because what if there was another way? What if there was a way that they could take the interest rate and make it not really matter because of the way the payments are applied? What if there was a way that the payment could be applied to principal first and then interest?
Oh, that would be powerful.
Absolutely. What if there was a way to pay off the mortgage faster? What if there was a way that they could still keep their funds liquid to be able to take care of opportunities or emergencies that come along and protect their family from unforeseen circumstances.
That's interesting. So
yeah, it's
tell me
pretty
more
cool.
about like how it's structured. Like how does the interest really work?
Okay, so basically the way the all-in-one works is it is a first lien home equity line of credit.
Okay.
Combined with a checking account with a sweep feature.
Okay.
So that means that when income is deposited into the checking, that automatically sweeps over to lower the principal balance on the line of credit. So then a client would then take their favorite credit card, the one with the most points or miles, and put all their regular expenses, their electric bill, their food, their gas, whatever it may be, and throw it on that card until the day before their next payday. And then the day before the next payday, they turn around and use the line of credit to zero out that card so they never pay any interest on that credit card.
Okay.
Okay. And that means that it's only one day, the day between the day before they get paid and the next day, that they're paying a little bit higher in interest, because the interest is calculating on what is the principal balance at the end of every day. So they only have one day of that elevated interest, and then the very next day they get paid again and it drops right back down. And then they go ahead and pay their bills just like they normally would, and then right before the next payday, they zero out the card. They only have that one day. So instead of paying elevated interest for all 30 days like you would on a 30-year fixed rate loan, you're only paying that higher bit of interest 2 days out of 30.
So you're saving money there.
Yes, it will actually save hundreds of thousands of dollars over a 30-year fixed term.
So let's think about this. So you're saying that with this program, ultimately you're paying the principal first. So how long are you seeing these mortgages being paid off, paid in full?
I've actually got a specific scenario in here that we can walk
nice.
through. So this is that one that I was saying, $650,000 purchase price, $520,000 loan amount. We're comparing against a 30-year fixed rate at the same interest rate. I did 7.35 for both.
Okay.
In this case, a buyer would have an income of about $105,000. So they're receiving about $43.75 on the 1st and 15th when they get paid. They have 20% positive cash flow. So at the end of the month, after they pay all their expenses, they've got about 20% left.
Okay.
And then in this particular case, this buyer also had an emergency reserve of about $52,000.
Okay.
So 10%, which most people want to have about a 6-month emergency reserve.
sure.
If you've got $105,000 in income, that is about where your emergency reserve is going to be. Okay, so I've actually got how the payments are applied, a calculation in here that shows you if they're on that 30-year fixed rate mortgage, their daily interest amount would be $106.17. Okay. If we were looking at the all-in-one loan, which is the option with the colored pieces in there on the right, on day one, since he's paid on the 1st and 15th, on the first day of the month, that drops the principal down from the $520,000 to $515,625, and it means the daily interest is $105.27. And it goes like that until he gets to the 14th, because he gets paid on the 15th. So on the 14th, he pays off his credit card, and let's say he put $3,000 worth of expenses on that card. So now the interest or the principal balance pops up to $518,625. The very next day, pops back down when he gets paid. And now we're down to interest of $104.99 on a day. And that continues that way until the last day of the month. Since he's going to get paid on the 1st, on the 30th, he's going to zero out that card again, and the principal balance is going to pop up for a day again to paying interest of $105.61. So at the end of the month, yes, he has saved only $30.06, but this is month one of $360. Number two, you can see the principal balance at the end of the month on his transaction is $2,300 lower than the 30-year fixed. So you can see how that turns around and just capitalizes on itself. So what's going to happen in the end with the all-in-one loan, they will have paid it off in 10.8 years as opposed to 30. Yes.
Now, this is exciting.
Right.
Are you all excited?
Exactly.
Yes.
And they will have saved over $500,000.
Oh my goodness. Like this program is a game changer.
It absolutely is a game
right.
changer.
And I get it. Like you said a lot of things. You broke it down. Let's talk about, let's say, someone is just completely a new home buyer, math is foreign to them. They just want to know bottom line. What do they need to know if you had to bullet this in a few bullets?
So the big things that they're going to want to pay attention to, and this kind of comes in mind for the pros and cons, as well as
exactly. Because is there a catch? I'm sure some folks are probably thinking about this, right? Is
absolutely.
It for everyone?
Absolutely. So first things first, it is available for all occupancy types, but it does require a little bit more down. You're not going to get your FHA 3.5% down option. Owner occupied is 10% down. Second home is 20% down.
Okay.
Investment property is 25% down, but we can do all occupancy types on this program.
Okay, nice.
So it's phenomenal for investors.
Yeah, right.
So the program is designed for those with a positive cash flow on a monthly basis.
Okay.
So the maximum debt ratio is 43%. So for those that don't understand a debt ratio, when you look at your monthly income, your total expenses that appear on your credit report, so car payment, credit cards, things like that show on the credit report, plus the house payment, can't be more than 43% of your monthly income.
Okay.
That leaves you with the remaining space to be able to keep that principal low and cover things that don't appear on the credit report, like your income taxes, your food, your utilities.
Right.
Okay? There are reserve requirements. So basically, they want to see you with money left over after the transaction is completed.
Okay. You need a savings.
Exactly. You need a savings of 10% of the line amount if your debt to income ratio is below 40.
Okay.
Or 15% if it's between 40 and 43.
Okay.
Okay. So hypothetically speaking, that's why I placed the emergency reserve at $52,000 on my example, because it's $520,000 loan amount. $52,000 would be that 10% marker.
Okay.
Okay. And then the other piece is at the time of closing, it'll look like there's an extra 1% in closing costs. It's not actually a closing cost.
Okay.
1% of the line amount is collected at the time of closing to front end load that checking account. That's the initial deposit to the checking account, because it will take a couple of weeks for everything to be set up and get your direct deposits transferred over and all of that.
Right.
So if there's interest that comes due before you've got all your stuff set up, there's something in the account to cover that, and nobody's sending you a bill for your interest.
Right. Okay.
It's automatically taken care of out of the account. So people ask, what's the minimum payment on this? There really isn't one, because as long as you're keeping it below that minimum balance, it's automatically going to capitalize the interest in that line, but it's never going to become negative amortization. So it's never going to go above that line limit.
Okay.
So if that loan amount's $520,000, what you owe on that is never going to go above that. If you're bumping up against it, that's when you're going to get a statement from us that says you need to pay this much to make sure you stay below your line.
Okay.
Okay. And then the last piece that some people consider it a negative. Personally, I consider it a neutral factor. This is an adjustable rate loan.
Okay.
Okay.
Let's talk more
so
about that.
yes, the interest rate can go up. But the interest rate can also go down.
Right.
Okay. So the floor on it is 3.75%. So that's the lowest it can go.
Okay. So if interest rates ever drop down back to where it was just a few years ago, you can take advantage of that without refinancing.
Without refinancing. Exactly. So then at that point in time, it would automatically drop that interest calculation down to what that interest looks like.
Okay.
That interest
You don't have
rate.
to do anything.
You
It just
don't have to
happens
do
by
anything.
itself.
There's no paying $4,000 or $5,000
Yes.
to refinance. There's no starting the 30 years over. It just automatically happens.
Look at that.
You don't even have to call us about it. It's
Right.
just
It just
gonna happen.
happens.
Yes. Yes. So
that's auto savings. Are you guys hearing this? We're talking about automatic savings. You don't have to call, pay the extra funds. You have the ability to pay off your home in 10 years. Have you seen it done in less time?
Absolutely. I did one this week that he came out to 7.8 years because he had significant money sitting in the bank
Yes.
that he didn't wind up using for this particular purchase that he could turn around and drop it in there. And so, yeah, it wound up being 7.8 years. And then commonly I see, typically the range that I see is between 8 and 12 years.
Okay.
That's the most common
That's still
range.
amazing. We're talking about 30, right? Versus that.
Exactly.
That's huge.
It's huge.
That's
it's
huge.
absolutely huge. And like I said, it's phenomenal because you don't even have to think about refinancing.
Right.
It automatically happens. Yes, is there the risk that the interest rates can go up? Absolutely there is.
Right.
But they're not likely to stay that way. And
Right.
if you look at the actual math on it, you can see here that with the interest rate, the compound effective interest rate would have to be over 12% for the entire life of that all-in-one loan
Okay.
to come out to as much as you would pay on that comparison 30-year
On a
fixed.
standard fixed 30
Yes.
year. So
The effective APR. But if you're doing it the way that this particular example does,
Yes.
with that 20% left over, you're putting your
Right.
money in there, you're doing exactly what I showed on here with how we showed the payment where the deposits come in,
Right.
all of that. The actual rate would turn around and come out to a rate in the twos. You can see on
Woo!
that.
Say that again. What was
a
that?
rate in the twos.
Could you imagine interest rates in the twos? Like what you can do, the power of that, right?
Well, we had that in 20 and 21.
It
And it was-
absolutely happened.
But it's gone now. And
Right.
so we don't have that now. And so, but people are going, okay, I don't want to give up my rate that's at 3.5 and all of this
Yeah.
kind of stuff. But with this program, you're not giving up anything because the effective rate comes out to 2.391.
You're still winning, no matter what.
You're still winning.
You're still
ahead
winning.
of the game.
So
Exactly.
what is, because you mentioned it's adjustable, it can go up, it can go down. Okay.
Yep.
What is the highest it can ever go up to? Just, I'm sure someone's wondering.
So if you started at that 7.35 as
Mm-hmm.
an example, 6% is the maximum. So
Okay.
it would be the 13.35 at that point.
When's
So-
the last time you ever saw interest rates getting up that high?
I've been doing this since 1992,
That's
and
veteran,
I've
y'all.
never.
A bet.
Yes, I stumbled into my first mortgage company about 6 months after I graduated high school.
Oh my gosh.
And I have never seen interest rates that high. They were ranging in the 8 to 10 range
Mm-hmm.
when I got into the industry. In fact, I actually have a slide for that. The
Of course
slides
you
I'm
do.
using on here are from a presentation that I gave yesterday, actually.
Oh, nice.
Yeah. So
Okay.
but
so
yeah.
you're educating everyone about this right
I
now, as you
absolutely
should
am.
be, right?
Absolutely. And I'm going to show you one more thing,
Please.
one more slide on here that makes it really cool.
Okay.
So we talked about their money staying liquid.
Okay.
I want to show you how that
Yes,
works.
please
so
do.
in
Please
this
do.
particular slide, you can see where the black line at the bottom, the black line there is how the principal balance comes down with the way that we have this structured with our example.
Mm-hmm.
And then the green line there, see how the green line stays pretty even and then it starts
Yeah.
to drop at the end? That would be your 30-year fixed. So that's how the 30-year fixed would move and how high your principal balance would stay. That blue line there that is showing that goes straight across and then slopes down, that's the line of credit that you can use there. So the difference between the black line and the blue line is the available funds that they could use for any sort of cash needed, whether it's an investment, whether it's an emergency, whether it's whatever it may be. You need
Right.
to send your kids to college, whatever it happens to be. You have that space to be able to play in.
Mm-hmm.
But you see how the blue line, it goes straight across for the first 10 years. So
Right.
for the first 10 years, that line at the 520,000, that cap at the 520,000 is going to stay the same for the first 10 years.
Okay.
The last 20 years, which is 240 payments worth,
Right.
that line limit is going to drop by 1/240th each month.
Okay.
So each month, it's going to lower the line amount by 1/240th so that at the end of the 30 years, the line limit is 0 and the balance is 0 and you're just done.
Interesting.
Okay.
So what happens when you're just done? What does that look like?
That looks like your balance is at zero and your line amount's at zero, and we send you a piece of paper that says our lien is released and it's been recorded against the public record that we no longer have a lien against this property.
Woohoo!
So, yes,
So it's time to party.
Like. Yeah.
Right?
Yep. It's time to party.
It's time to party.
Well, actually, it's time to party at year 10 when you've got that down to zero.
Oh my
because,
gosh. Yes.
then anything you borrow is just your choice.
Yeah.
And people ask, how do you access the account? Well, the methods are the same as your regular checking account.
Okay.
So you'll have a debit card. You'll have a checkbook. You'll have the ability to wire funds, ACH funds. You can send your Zells. You can walk into an ATM and pull out cash. However you would normally access your funds, you can access it the same way.
Nice.
So we were talking about investment properties before and how cool this is for that. So imagine you've got your tenants set up to drop their rent payment right into the checking account that's tied to this, and it automatically pays down your principal balance. Let's say 5 years down the road, the AC blows on the rental property. Now as a landlord, I don't have to dip into my investments elsewhere.
Right. Or pay out of pocket.
I don't have to liquidate cash I have elsewhere. I don't have to do anything with money I have in another place that's earmarked for something else to pull that $25,000 to replace that unit.
Yes.
I just take the debit card that's attached to this account, walk into Home Depot, Lowe's, wherever I want, slide that card, pay for it, and say, go install it.
Right.
And just walk away, and the rents continue to knock it right back down the same way they were.
Wow. Now, does that extend the amount of time before the mortgage is paid off because now you're pulling more money? Yes.
Absolutely.
But regardless, you're still paying it
off just as quick. So yes. Now let's talk about one other place where the availability of those funds are helpful. Let's say you have an unforeseen circumstance such as an injury, a layoff, a reason that you have 6 to 9 months that you can't make your mortgage payment. The example
life happens. Basically.
Life happens. The example that I gave yesterday is, our borrower's a single person. They were installing their Christmas lights, fell off a ladder, and wound up in a coma for 9 months. There's nobody to make their mortgage payment for 9 months. What happens if they have a 30-year fixed?
Default.
Their credit's destroyed. Their home's foreclosed. They've got nothing. They've got nothing. What happens if they have an all-in-one?
What happens?
The interest from those 9 months capitalizes inside that line of credit, and they get out and go, oh, thank God.
Oh.
Because they've never had a late payment show up because it just capitalized inside itself. And they come out and they go, ooh, my balance is a little higher. That's kind of nasty, but I've got a home,
But
so
I
I'm
have
good.
a home, right?
Exactly. So that is actually the reason this program, like I said, we patented it a little over 20 years ago.
Okay.
CMG did. And in the 20 plus years that this program has been in existence, we have not had one single foreclosure on this program in over 20 years.
Not one.
Not one.
Because it's funny you brought that up. I promise you that was my next question, right? It's new. It almost sounds too good to be true. Like, not one default in 20 years.
Yes, ma'am.
You guys, it sounds like gold to it. It sounds like gold to me. So I mean, seriously, and it's okay. And it's okay, guys. Like if you had a moment, and you're kind of like maybe you got lost in the translation of whatever we're talking about. That's why my phone number and or email is down in the description, and we can talk more about it. Donnie, where can they find you?
I was just going to ask, do you mind if I share my piece?
Please do.
There's this. And because the presentation I was giving yesterday was to realtors, that's why I have it. My number one piece of advice for realtors out there, build amazing strategic partnerships that you can count on with people you love working with, like I love working with you, so that you have the people out there that can help you strategize this put it together.
That's right.
Absolutely.
That's right.
So there's my contact.
I love it. I love it. Thank you so much. Thank you. Honestly, you dropped, per usual, you dropped some gems today. And just to make it real clear, this program is only offered at CMG Home Loans. So that means you can only get it by working with Donnie. Woo! That was good, y'all. So if you have any additional questions, if this just seems interesting to you, I want to hear about it in the comments, okay? If I get more questions, we'll even do a part 2 because we didn't even have enough time to go over all the things. There's more. There's more. So if you have questions, again, drop them in the comments. Give me a call, give me a ring, shoot me a text. I would love to work with you. I would love to answer your questions and just be a resource. Until next time.